Hello students, Professor Watts here, and welcome to the next installment, Finance 616. And we're working with Chapter 2 of our textbook, Higgins, his Financial Analysis. Excellent book, by the way. It's the first time I've used it, and I've really started digging into it and like it a lot. Very, very well written, very clear. I don't think you're going to find a better finance book. So with that in mind, we did look at my other video on financial ratios from a previous class, and that overlaps well enough with what this book covers. But this book digs into more detail on the return on equity in particular. And I think it's worthwhile to spend a little bit more time on this. Now, I'm not going to cover every single thing in the book, but I'm just going to pick and highlight some of the big themes and elements that I think are worth really knowing about. So let's just jump right in to return on equity. Now, as they say in the book, this is the most popular measure of financial performance. And there's some limitations and drawbacks, which we'll cover briefly in a few minutes. But the power of ROE is that not only does it give us a good measurement of the financial performance, but it actually we can decompose it into three components and then kind of think about which of those components, or maybe a combination of those in some cases, is driving the firm's performance. And the authors of the book call this the levers of financial performance. And then they're going to use a lot of real world examples. You might have noticed already that they're focusing on this company Polaris. They make like sports vehicles, rec vehicles like ATVs, motorcycles, snowmobiles type things. So they grab that company and use their actual financials as an example throughout the book, which is pretty cool. So anyway, we've got the ROE numbers here for 2020 for Polaris, 414 million in net income divided by 1.4 billion in shareholders' equity, book value of equity for an ROE of 29%. Is that good, bad, or indifferent? Well, it kind of all depends, right? We want to compare it to this company in the past, see how they're trending, and we also want to compare it to other kind of companies in the industry and then maybe other industries, because this is ultimately kind of a metric of performance that investors are looking at, right? Do you want to invest in this company? Well, you want to look at their ROE in addition to other things. I'll just give you kind of a quick gut instinct on this. Is like, yeah, that looks like a pretty good ROE. I know I can earn 4% right now. I think it's 4.2% if I invest in U.S. government 10-year Treasury bonds, and that's perfectly safe and very liquid. So if I'm investing in anything else that's a risk-based asset, it's going to have to be well north of that risk-free rate of return. And this is almost 30%. So if Polaris continues this going into the future, that's going to be like 5 or 6 times better than I could get on a safe risk-free asset. So that's probably going to compensate me for the risk and be a nice investment. So let's go into the determinants or the levers of ROE. We can break it down into these three components: profit margin times asset turnover times financial leverage. And some of these you're going to be familiar with. Maybe some of them will be new to you. Profit margin, well, that's simple. That's just income over sales or profit over sales. We're all probably familiar with that. Don't need to say much about it. Asset turnovers. So what is that? Well, that's sales, so total revenue, divided by the total asset base, or the value of all the assets of the company. And then finally, financial leverage. And I bet some of you are familiar with the concept of leverage. This is the assets divided by the equity. Now, I'll get into a little bit of a breakdown on each of these components here, because I want some kind of intuition and I want to give some examples so we can think about them. And then we'll jump to what the book has in terms of looking at real world companies and kind of compare and contrast, and then to think about what's driving return. It could be one, it's usually one of these in particular, sometimes a combination of two. So here's the data. The book continues with the example Polaris, their ROE for their 2020, 28%, and that broke down into a profit margin of about 5.8%, asset turnover ratio of about 1.4, and then a leverage ratio of about 3.4. Okay, so now what do these numbers mean? Well, we'll discuss and we'll compare Polaris to other businesses, but let me think about some intuition about those components. So the three components: profit margin, asset turnover, and then leverage. So profit margin. Now, we all know what profit margin means, right? How much profit do you make on your product? How much more than the cost of making the product can you charge to the customers? Well, that's ultimately driven basically by one and only one thing, and that's competitiveness. How competitive is the market? The more competitive the marketplace, the lower the profit margin is going to be. Examples of low profit margin businesses: grocery stores, right? Discount stores, your Walmart, your Meijer, your Dollar General, your fast food places. Okay, don't expect high profit margins here. I don't care how good the food is or how nice the service is. It's competitive, right? Where can you get groceries? Meijer, Walmart, Kroger, Safeway, Dollar General, Aldi, right? Where can you go for a good hamburger and fries? McDonald's, Wendy's, Burger King, Culver, et cetera, et cetera. So tons of competition driving profit margins down. In fact, you probably remember from, hopefully you've taken some micro econ classes. One of the big themes, I teach this a lot, and this is one of the most important things I want students to walk away from those classes with. Profits are eliminated in long run competitive equilibrium. So the kind of the hallmark of competitive markets is profit rates are brought down to where they're just paying a sufficient return on the invested capital, and really no more than that, because if profits were larger, they'd attract new competitors, and those new competitors would compete with lower priced products, and that would pull the profits back down again. Now, how can you try to achieve higher profit margins? And well, you have to have what we call barriers to entry. You have to have some kind of way of blocking out competitors from coming in, duplicating your product or imitating your product and offering it at a lower price. And if you do so, you can, if you're capable of doing this, you can turn profits into what we call rents. Rents are returns on assets that can't be competed away. Technically speaking, we say that fixed assets earn rents, and fixed assets are things that you can't just duplicate or replicate. They're kind of unique, they're special. So you think about businesses that earn consistent high profits, they're probably actually, technically speaking, earning rents because they have fixed assets that can't be duplicated. So for example, intellectual property protections, like pharmaceutical companies that have patents on their prescription drugs, and they earn rents on that because that can't just be imitated and replicated by a competitor. Sometimes I've heard the term moat applied here, and that's a business needs a moat against competition that would erode profitability. So a friend of mine who's an investor, when he's analyzing business opportunities, he's always asking, what's the moat? Because if we make a high rate of return on this investment, how do we ensure that we're not going to attract a bunch of imitators who will pull the price down and then take the return on the investment down with it? Okay, so profit margin, easy, a little bit basic economics there. Let's move on to the next one, which is a little trickier, asset turnover. It's actually not that tricky, though. It's just a measure of how capital intensive the business is. If you have a large capital base, in other words, you need a lot of equipment, machines, buildings, factories to run the business, you got a lot of assets on the books, you're probably going to have a smaller asset turnover ratio. In other words, you're going to get fewer sales per dollar of assets invested or owned by the business. Railroads, airlines, utilities, right? A railroad has to own all the tracks and all the engines and all the cars and a bunch of machinery, right? Airline, they own really, really expensive airplanes. They have to own a lot of them. They have to have a lot of equipment, trucks and baggage, machines, all that kind of stuff. So a utility, has to own the power plant and then all the transmission lines, lots of equipment, lots of vehicles. So capital intensive businesses going to have a low asset turnover there because they have so much in assets. They're going to have a small amount of sales relative to assets. If you have a smaller capital base, you're going to have a larger asset turnover. What that means is you can get a lot of sales with a smaller amount of assets. Think about a discount retailer. Think about like a Dollar General. The assets there they're pretty simple buildings, that have shelves and a checkout that's pretty inexpensive. I bet it costs them $100,000 to build a location, and they pump a lot of sales. They're moving a lot of product out the door every day, lots of sales per dollar of assets, and therefore going to have a larger asset turnover. Okay, then finally we got the assets to equity ratio, which is a measurement of leverage. Now, I hope you're familiar with the term leverage. Very, very important. Leverage is a measure of debt. How much debt is the business using to finance its operations? More leverage means more debt relative to equity. In other words, more borrowed funds used to run the business as opposed to funds invested by the owners, which of course is equity, right? You're all familiar with owner's equity. So high leverage, meaning high debt, you're going to have a higher asset to equity ratio. Meaning, and the math of that is like the equity part, which is the denominator, is smaller for a given amount of assets, right? Or the assets are larger for a given amount of equity. High leverage, higher asset to equity ratio. And it's when we get to the examples here in a minute, you'll see that those can be large. With some cases looking at double-digit asset to equity ratios. Businesses funded more with other people's money. Guys who are into leverage will talk about we want to use other people's money, not our own money, to run the business. Low leverage, of course, low debt, lower asset to equity ratio. And the lowest this could be is 1. All of the assets funded by equity. That would be an asset to equity ratio of 1. So it's got a lower bound of 1. The upper bound, maybe double digits. Some businesses might go up into the 20s, 30s, 40s. And as we'll discuss here momentarily, the higher that asset to equity, the higher the leverage, the greater the risk. Leverage equals risk. Debt has to be repaid. Equity does not. And if your revenue declines and or your costs rise, your profits shrink, you get less cash flow with which to meet your debt payments. And the worst case scenario, of course, is you don't have enough cash flow to cover the debt payment. So if you've levered up, if you borrowed a lot of money to run the business, and you might have had a few good years of sales and a high ROE based on the leverage, but as soon as you hit a bad year, sales decline, costs rise, cash flows down. Now you can't meet the debt payments, and you may be facing prospect of bankruptcy, liquidation, reorganization, etc. Very, very bad. So leverage equals risk, and we got to tread carefully when we're thinking about leverage. Now let's look at some actual ROEs and then their breakdowns into the 3 components: profit margin, asset turnover, and leverage or asset to equity. And we can see kind of how different companies operate kind of based on the 3 components we just talked about: the competitiveness, which is going to drive the profit margin, the size of the asset base, whether they're capital intensive or not, that's driving the asset turnover, and then the amount of leverage. Now, of course, any company could decide to use more leverage, use more debt, and that would always drive up their ROE, but we'll find that there's kind of a balance here. So because of the risk involved, and so certain businesses, it makes more sense to use leverage, and certain businesses makes more sense to have more equity and lower leverage. So let's start by kind of just looking at the ROE, the range, and notice we've got a diverse range of businesses here. Alphabet, that you know them as Google, right? Internet. Citigroup, you probably heard of, one of the biggest banking businesses in the United States, very, very large. Diageo is a big liquor distributor. This is the only company on the list I didn't know off the top of my head. I had to actually look that up. Kroger, probably a company you've heard of, a big grocery chain, pretty national, I think. Microsoft, of course, we all know and love, maybe, or hate. Norfolk Southern, big railroad, big nationwide railroad. Novartis, a big pharmaceutical company. Polaris, that's our example company from the book. Motorsports. Target, big retailer. I'm sure we've all been there. Wendy's, one of my favorite fast food places. Good hamburger and French fries joint, right? So lots of different kinds of businesses here, and then we see a range of ROEs. Smallest one, 6% here with Citigroup, all the way up to, let's see, the biggest one is Microsoft, 37%. So wow, you can have then everything in between. So is one of these, we want a better ROE, of course, if we're investing, but let's think about the subcomponents, what's driving these larger ROEs. So first of all, profit margin, okay? What's the biggest profit margin? Microsoft's got 31, that's pretty darn impressive. And let's see, the smallest one would be Kroger, at just 2. Well, what's the difference in those business models? Okay, Kroger, as I mentioned, very, very competitive industry. You're not going to be able to mark up groceries very much above cost. Why? Because if Kroger tries to get a profit margin of 3 or 4 or 5%, Safeway or Meijer or Walmart or Aldi, low profit margins in grocery. Look at Target. It's just under 5%. Low margins in retail. Um, Polaris, I was a little surprised that Polaris's margins were so low, but if you think about it, if you want a snowmobile or motorcycle, whatever, well, Polaris is just one of many, many choices. Makes sense that the profit margins are low. Look at even Wendy's here at 7%. Well, yeah, it's very competitive. Wendy's maybe has like a fan base and they've got certain products that the people like, oh, I want to get a Wendy's rather than McDonald's because I like the Baconator or whatever. But if they can't raise the prices too much, because if it's too expensive, I'm a Wendy's fan, but I would go to McDonald's or Burger King. So competition driving the profit. These high profit companies like Microsoft, well, they've got a unique product and they've probably got some copyrights or some intellectual property. They've got a huge locked in client base, like companies that use Microsoft. They can't just easily switch to another competitor's products, right? They'd have to install the software on every single person's computer and then do a lot of training. So Microsoft has some advantages, limited realm of competition. Okay, and then you can see there's kind of everything in between that would indicate the competitiveness. So if you can have a moat, if you can have protection and earn rents, well, you're going to get a lot of ROE from profit alone. Otherwise, if you got low profit margin, you can still have a very respectable ROE. Look at Kroger here, 27% ROE. It's not happening through profit margin, so it's got to be happening through the other factors, right? So let's move over to asset turnover. And speaking of Kroger, they're the tops here in asset turnover. They are producing a lot of sales with their asset base. That means they don't need a whole lot of capital and they're generating a ton of sales. And if you think about it, a grocery store is, it's a big national chain. They've got a lot of assets, but relative to sales, it's not that much. It's a building with shelves, registers, freezers, refrigerators, but they're moving that product every day, right? Product every day comes in the back. They stock it out on the shelves. It goes out the front door. So lots of volume, right? What's the business model of a grocery store? Low margin, low markup, high volume, right? They make up for it on volume. So there you see the strongest asset turnover, almost 3. Next highest is Target, which is kind of similar, a little bit more premium, a little less volume, a little less inventory turnover, but still a pretty large asset turnover. There's Polaris. Polaris wants to move those vehicles through the dealerships, so they're all above 1. And then notice all the other ones are pretty small. They're well below 1. Look at Wendy's. I was kind of surprised that Wendy's was so low here, but if you think about it, it takes a lot of capital for Wendy's to generate its sales because they have a ton of locations and they got a lot of equipment in those locations. They've got they have to have a freezer and ovens and all that stuff. So makes sense. A little bit more capital intensive business. I think the smallest one on here, well, Citigroup, we'll talk about them, but look at the railroad. Very much capital there, right? All the tracks, all the cars, the engines, the freight yards. Why would Citigroup be so low? Well, banking is a business where if you think about capital in the sense of financial capital, they have to bring in a lot of funds in order to make loans where they make a pretty small margin. They're probably making a lot of mortgages where their yield spread is only a couple of percentage points. So asset turnover, you can see kind of hopefully how that plays in here. And then finally, leverage. Okay, the big one, we're going to talk a lot more about this. And you can see leverage, nobody's at a 1. A leverage of 1 would be no debt, but you can see Alphabet here, only 1.4, really low leverage, barely any debt in that company. The book goes into some detail about Alphabet. They've got a ton of cash, and they're largely financing with retained earnings, don't need to borrow a lot of money, but a little bit abnormal there. Our retailers, about in the 5. Let's see, Target's in the 3.5s. Wendy's all the way up here at 9. Wendy's using a lot more debt versus equity. The liquor company here, they're about a 5. The book will talk about how if you can afford, it's safer and you can afford to use more debt versus equity if you've got a pretty stable business. So a business like Kroger, that's not going to be too sensitive to the economy. It's going to be pretty stable. People need to eat, right? People are going to buy groceries even if their incomes are down. So pretty stable, steady business, a little bit safer to use more debt. So you'll see the higher leverage ratios in those kind of businesses. Okay, now let's talk about measuring leverage just briefly. I think I covered some of this stuff in the other video, but just while we're on the topic of leverage. So we can think about the debt ratios, debt to assets, debt to equity. Of course, debt to assets, total liabilities, the total amount you owe, divided by total assets, the total amount of assets owned by the firm. And then debt to equity, that's total liabilities just divided by equity. So they calculated these for us for Polaris. Debt to assets, 71%. So debt is 71% of the asset base. What does that mean? Well, notice what it says here, percent of assets paid for by creditors. So creditors, meaning the people who lent funds to the business, finance 71% of it. You think about debt to equity, of course, that's going to be way higher than debt to assets because equity is going to be a small core of the funding base for the business. So debt to equity, 243% there. What was the leverage ratio for Polaris? 3.4. Not extreme, but a little bit on the higher side of our leverage. Well, probably kind of right in the middle, actually, of our leverage. Okay, market value. Now, these calculations here are taking the book value of assets and equity, and we might say, well, if this is a publicly traded company, that equity could really change in value based on what's happening in the stock market. So we might want to take the market value, and this is going to be pretty important for a public company. So the market value of debt, now that's probably going to be pretty close to what's reported in the balance sheet, but the market value of equity for a public company could vary widely. The value of the stock goes up if the stock market, if investors think this company is going to do better in the future, so the market value could be way higher than the book value. So market debt to equity takes the market value of debt divided by what we would call the market cap of the company, the shares times the stock price. If you've taken any investing classes yet, you know this is market cap. So in the case of Polaris, debt to equity is going to be lower because, of course, the market value of the equity is substantially higher. It's almost $6 billion, whereas the book value here in our other calculation was 1.4 billion. So we can think about the debt as a percent of assets or equity, and we also want to think about coverage ratios, which is kind of earnings available to pay for the debt. And there's a couple things here we'll look at: times interest earnings before interest and taxes divided by interest. So how many times will their earnings pay the interest on the debt? And for Polaris, it was 8.8 times. So we got earnings EBIT of 588 mil and interest expense of 67 mil. Times burden covered, that's how many times your earnings would cover your entire debt burden, not just the interest on the debt, but the interest and the principal. So that, of course, is going to be smaller, but 2.4, probably pretty healthy. They have enough earnings to pay their debt 2.5 times over, probably pretty safe. That number starts getting down closer to 1. That's trouble. If it gets less than 1, this company's probably headed off a cliff. Let's conclude by talking about some problems with return on equity and maybe look at a little bit different kind of picture of financial performance. The book's going to talk about 3 issues with return on equity. Number 1, timing. ROE is backward looking, and ROE could be great for the past year or the past several years, but if future performance doesn't hold up, ROE could collapse. So it lacks a long-term perspective. Something like the stock market, that's based on the estimations of forward earnings. So it might be better to look at what the market's doing with respect to valuing the firm's equity and market's estimation of the prospects for the firm's future earnings. Risk, of course, more debt, more risk. That's the nature of leverage. And you can drive your ROE up with debt, but that includes risk, and ROE doesn't really account for or measure or include that increased risk. Debt incurs fixed payment obligations, right? You got to pay the interest, you got to pay the principal. If cash flow declines, you still have to service the debt. if you have a bad year, costs are high, revenues are low, and you have a lot of leverage, you might not have enough cash flow to service the debt, to pay the interest and or principal. And if that's the case, you are really in trouble. The creditors could force you into bankruptcy to make sure that they can get paid, rather than having you go out of business and default. And okay, and then finally, there's this value issue. ROE uses book value, and we want to look at market value. We've already kind of taken a look at that. We'll take another look here in a minute. Market value is what the current value of the company's equity is, rather than what was initially contributed. Public companies' earnings yield, or the flip of that is the PE ratio, is probably a better performance metric because it's based on the current market valuation of the firm's equity base. The book says, because of risk associated with leverage and the fact that you can boost ROE with a lot of leverage, maybe ROE isn't the best thing to look at, or maybe we should at least temper ROE by looking at an alternative measurement of performance. And what they've proposed for us is return on invested capital, ROIC. That measures the return independent of leverage. So it takes earnings, and it takes earnings before interest and taxes, because it kind of wants to cancel out the impact of debt. So we're not going to look at interest or taxes. And you probably know from your accounting or previous finance classes, debt-based financing has a tax advantage because the interest you pay is an expense, right? So we adjust for that by multiplying, kind of taking earnings net of taxes, multiplying it by 1 minus the tax rate. That's called the retention rate. And then dividing it by debt and equity combined, interest-bearing debt and equity combined. So this is like, you can think of the denominator here as the total capital base, or the total, the total funds required to fund the company's assets, and then the EBIT time the retention EBIT, which is the net earnings of the company. So net earnings divided by all the funds we brought, whether debt or equity. So that's ROIC, and that's a little bit more of a robust picture probably of this company's performance. And of course, it's going to be lower, obviously, than return on equity, but higher than return on assets, right? It's kind of a middle ground in between the two. 16.3% here for Polaris. So the book has a really cool example, and it's really, you can see the math is super simple. They just put some round numbers in here. Two companies that have the exact same asset base, $1 million worth of assets each, and the exact same earnings, $120,000 worth of EBIT. But one is 100%. It's all equity. Company B, all equity, no debt at all. So of course their debt to equity, or their assets to equity ratio would be 1. They don't have a debt to equity ratio. And you can see that the ROA is the same as the ROE. And of course, it's the same as the ROIC, 9%. Right? What happens when we lever up? So the same $1 million worth of assets is now financed almost exclusively by debt, 900,000 by debt and only 100,000 by equity. So this kind of tells you that the owners of the company, and if this is a corporation, these would be the stockholders, they only had to put in $1, and the company acquires $10 worth of assets because 90% of it's funded by debt, right? So this is a highly, highly levered company. Well, notice that ROA is a paltry 2.3%, but here's what leverage does. It makes your ROE so much higher, almost 23%. And you think about it, that's about 10 times higher. They have about 10 times more debt compared to equity. So you can see that that's in parallel with the ratio of debt to equity. However, the ROIC, right, it's taking the earnings just divided by the total financing base, debt and equity, and it's going to be exactly the same. So the ROIC strips away kind of the magic of leverage and maybe gives you more of a balanced picture. So something that's worth knowing about and worth looking at in addition to your ROE measurement. Now, just a couple more quick things and we'll wrap up here. The book talks about the value problem of ROE. And we've mentioned this, should we calculate return on book equity or market equity? Well, what's the company worth? The current market price of the company, the market price of the shares, is a probably more realistic indication of their value of their equity than the book value. ROE using market value. Well, that's earnings yield. Okay, and earnings yield is something that's very common and popular amongst investment stock market analysts. You just take net income divided by the market value or the market cap, which on a per share basis would be earnings per share divided by the share price. Now, you might have come across earnings yield before. If you pay attention to stocks at all, you'll definitely hear about the PE ratio. And that's just flipping this. That's just the reciprocal of earnings yield. Okay, earnings yield, 669 per share divided of earnings divided by a share price of $95, 7%. Flip that around, $95 per share divided by earnings of 6.69, 14.2. Okay, 7 out of 100 is the earnings yield. The reciprocal of that is 100 divided by 7. That's the PE ratio. Okay, these are essentially the same tool. Different people will talk about the yield or the PE in other investment fields outside of the stock market. A lot of times they just talk about the multiple. Okay, so there's your little kind of brief primer rundown on ROE. We could say a lot more about this, but I think we've covered the basics for now, and hopefully you're in good shape to tackle the quiz and any upcoming assignments. See you soon.